Are you thinking of going from renter to homeowner? Well, this week's Money in Your Pocket is just for you. Mary White from First Mid-Illinois Bank and Trust will be here to talk to us about the home buying process, from getting your credit in order to pre-approval to final closing. There's a lot of information you need to know when it comes to buying that first home, so stay tuned because Money in Your Pocket starts right now.
This program is made possible in part by Credit Union One, proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.
On this edition of Money in Your Pocket, we're talking about the basics of home buying, and I'm here with Mary White, who is Assistant Vice President of Mortgage Lending at First Mid-Illinois Bank and Trust. Thanks for coming by, Mary.
Thank you. Thanks for having me.
Well, tell us a little bit about what you do. You've been in this business for a long time, and I know you've done lots of mortgages for people over the years.
Right. I've been in the banking business since 1977, and mortgage lending is my favorite place to be. So I'm a mortgage lender. I have people come in whether they're buying their first home or buying their 20th home, and to help them get into that property.
So we want to talk today to those people out there who are watching about buying their first home. And when should, in the process, maybe someone's sitting at home and they say, you know what, I'm tired of renting. I'm ready to buy a home. What should be their next step?
Well, I think their first step really should be to find a lender, and hopefully me, but find a lender to get pre-approved. Mm-hmm. And pre-approved means that you're actually going to come in and you're going to bring your financial paperwork in with you, your taxes, your pay stubs, and we're going to draw a credit report up. And that's the difference between pre-qualified and pre-approval.
Okay.
That we're going to draw a credit report and we're going to see what's going on and try to get you into that priced home that you want to be.
Because do you find sometimes people may do the opposite first and find the home maybe online, because that's the fun part, right?
Right, that's right. That's the fun part.
And then realize, oh, I can't really afford that home.
Right. Yeah, they can. I think it's a little intimidating coming into the bank and sharing everything that you have, and it is more fun to be looking online for the house. But when you're really serious about making an offer on a property and you're working with a realtor, they're going to want a pre-approval. They want to see that you've actually talked to somebody, that you've done your homework and you're serious.
You had mentioned pre-qualified and pre-approval. Are they not the same thing?
They're not. Pre-qualified means that we've ran your numbers and we've got you fit into this certain priced home or this payment. And the pre-approval takes it one step further and it actually draws the credit report.
Okay. So what are the kinds of things that you as a lender look at to determine how much of a house someone can afford?
Right. Well, we're going to look at stable employment, stable income. We're going to look at your tax returns, your W-2s. We're going to look at your monthly obligations, and that it does include student loans, whether they're in deferment, they're not in deferment. We're still calculating a payment for that. And then, of course, we're going to look at your credit history. So
how does your credit score affect the home buying or the mortgage process?
Yeah, it does a lot. It can determine whether or not you are going to be able to be qualified. It can affect your rate greatly.
Okay.
And it even affects some of the programs we have to offer.
So talk about rates. If you don't have a great credit rating versus a good credit rating, what could be the difference in your interest rates?
Well, it can vary from program to program, but it could be as much as a whole percent. And once again, it can actually throw you out of some really great low rate programs that we have, and you're going to go into a program that maybe pays a little higher rate.
Okay, we're going to talk about programs in just a little bit, but I wanted to ask about maybe you've got a married couple coming in to buy their first home. One of them has the good credit, the other one maybe not so much. How do you deal with that? Does it get combined?
Yeah, no, it doesn't.
Okay.
We've got to look at the lowest credit score out there, and so if there is a score that's low and we can't get them pre-qualified into or pre-approved into that loan program, we're going to look at the spouse that does have the good credit. Hopefully their income can suffice that payment, And if it doesn't, then they'll have to work on getting the credit issues taken care of.
How long typically, if they come to you and they've got some credit issues, and maybe it comes back that they're not quite ready to get that home, how long does it sometimes take to sort of resolve those credit issues?
That's a really good question. And I have that question a lot. And it really depends on how severe some of the credit might be. But we really like to see no derogatory credit for 12 months. I mean, that's a really good rule of thumb. But otherwise, we're just having them fix their credit, get in there, take care of everything, allow some time to heal their credit report, and then come back and see us. You know, let's give it another try. We're going to try for maybe 6 months. Maybe we'll try for 1 year.
Okay. You had mentioned programs, and there are several programs out there for first-time home buyers. How do you, as the home buyer, even know what's available?
It's hard. You know, we have a great website that will tell different loan programs, but it's really great. That's the time that you really want to see your lender, because it's hard for us to sort through all the programs out there. You know, we're gonna look at them to see where they fit in, and then we're gonna try to narrow down the programs that might work best for them. There's government programs out there. Illinois Housing Development Authority has a great new program out.
So let's talk a little bit about some of the things that people in our region might be able to take advantage of, like that last one you mentioned.
Yeah, Illinois Housing Development Authority is our typical first-time home buyer program. But they've actually recently came out with a program that you don't have to be a first-time home buyer. And that is extremely helpful, because there are second, third-time home buyers out there that don't have a lot of money down. Real Development's a great program. That's a government agency program. FHA, I'm sure everybody's heard of FHA, is a great program. And then our conventional programs.
So, but you still have to, there's different things that fit into those programs. And it's a mortgage lender that can help you get through that?
It really can. I mean, you can do a lot of research, and you can look those up online too, but it's really helpful to talk to somebody. I find that face-to-face sometimes, when you're really trying to narrow into what works best for your family, is great to do.
So are those programs based on any sort of set of common things, and if so, what might they be?
Yeah, the common things are credit, good credit, job stability, to be able to show that your employment is not only stable, but it's going to continue to be stable. And then the other points of that, just as any program would be, you know.
So there are, but I want to talk to our military and veterans. There are programs specifically for military people out there?
There are. Once again, Illinois Housing Development Authority, the IDA is what they call it. They've come out with a program that's for veterans or in the military, the National Reserves. And it allows them for some assistance money sometimes, really great low rates, and very little money down, maybe as little as $1,000.
Wow. So you talked about money down. That is something that comes up, is this down payment. And you know, we hear, oh, you need 20% down. Let's just talk about down payment in general and what options are available.
Right. Most of our government programs will have either 100% financing or $1,000 down. The FHA is 3.5% down, and if you don't qualify for those programs, and some of those programs are income restricted, and if your income is over that limit, then we're going to look at conventional, and the lowest down for conventional is 5%. And the 5% does have to be your money that you've saved. It can't be a gift.
Okay.
So that's our next program. And then we're going from there, and once again, credit scores can make the determination of whether it's 5% or 10%. And then 20%.
Let's talk about the 20% and private mortgage insurance, because that's a term that people probably have heard of.
Right, right. Any loan less than 100% or 20% down has private mortgage insurance. And private mortgage insurance is the highest for the least amount down, and then can tier then itself off at the 20%. There would be no need for that.
So what does the private mortgage insurance do?
It only is for the lender. It's to, in case that loan was in default, it would pay for that, help pay for that. So if you're looking at, for example, a $100,000 home, maybe putting 5% down, I mean, your private mortgage insurance could be about $80 a month. So that's a good amount of money.
And you pay that until you get to that 20% mark. Okay.
You do. On conventional, you do. On some of the government programs, it never drops, but it does tier down, so you're not paying that total amount for the whole term of the loan.
Okay, let's talk about some other terms. When you go on any home lending site, you see, 15, 20, 30-year. You see the word fixed. You may say adjustable rate mortgage. What does all that mean?
Yeah, right. Well, I think probably most people want to get into that fixed rate loan, and I can't blame them. And they're the lowest. They're the lowest out there. There used to be a time where your adjustable rate mortgages were lower than your fixed, but that's not happening right now. But the government programs or the fixed rate loans have a rule book very thick, and not everybody can fit into that program. And when that happens, and we're looking at alternate sources of a program like a 5/1 adjustable rate mortgage. Sometimes that, if you don't fit into that secondary market fixed loan, we can get you into that.
What is you talk about the benefits of the 15-year, 20-year, 30-year. How do you know what's going to work for you?
Yeah, you know what, that is a really personal choice, and it comes about a lot of times of what kind of payment that you can afford or you want to afford. Of course, that 30-year fixed rate mortgage is going to get you a much lower mortgage payment. And all of our mortgage you can prepay. So sometimes people will choose a lower payment knowing that they're going to prepay throughout their loan and pay it off in less than 30 years.
So let's talk about the actual mortgage payment, because I know, you go on a home buying site and they all have those mortgage calculators, and you put in the numbers and you get all excited and you think, oh, my house payment is about what my rent is. But there's other things that sometimes go into your mortgage payment that people should think about.
Yes. Yeah.
That makes it go up.
Right, taxes and insurance, not everybody has to escrow for taxes and insurance, but a lot of people will. Anytime you have less than 20% down, then you have to escrow for taxes and insurance with your monthly payment. And yeah, it could double your payment. It is something to consider, and would be your total monthly obligation.
So you mentioned another term, escrow. What is that?
Yeah, escrow is an account that's set to pay your taxes and your insurance on a monthly basis. You pay it at the same time. It's one big payment for you. But when your payment gets applied, your principal and interest gets paid towards your loan, and then the rest of it for taxes and insurance goes into a separate account. So when the taxes come out, your property taxes come out once a year, those get paid. When your insurance comes out once a year, that gets paid.
Do you think that property taxes are a thing that home buyers don't pay attention to?
Yeah, I think they're surprised. I think that they know they're out there. I just don't think they really understand what it means monthly. When you're talking, $100,000 property, and you may have to consider $300 a month of property insurance, home tax, that's something people are surprised about.
And the property taxes vary depending on the neighborhood you're in. They vary on lots of things. Right.
And purchase price is the biggest. I mean, and it should be, of course. The higher priced home would pay the most taxes. But yeah, there's that to consider for sure.
Yeah. So good idea to not get too excited about that mortgage calculator and that payment. Might want to double that, maybe not quite double that, but put a few more $100 on.
Right. Yeah, consider what those taxes, insurance, and you can, these days, you can get online, you can find out what the taxes are on a certain property.
So how should someone decide? The mortgage lender may tell you how much you can afford, but what about you as the consumer? How should you gauge how much house you should buy? Should you base it on your rent, your current rent payment? What?
That's a great place to start. And just knowing your budget, knowing, okay, if your rent payment is this amount of money, have you been saving extra money? Are you still able to save some money aside? Does that tell you then that you can afford a little bit more of a housing payment per month? And that's a great way to figure that out. And sometimes, like I said, your budget, so you're going to sit down hopefully and decide, no matter what I tell you, your house payment's going to be, what you really want to pay. And then we can take that payment and figure out what priced home you can be looking at.
One of the other things that seems to come up, we're talking about terms, are closing costs. And you see sometimes where, maybe the owner pays the closing costs. First of all, what are closing costs and what all goes into that?
Yeah, closing costs involve documentation fees that the lender can have, and if the loan is sold, what those documentation fees could be. But for the most part, they're their appraisal, their credit report, title, insurance. those are closing costs.
And how much are you looking at for closing costs?
And that can depend on the price of the home too, but I'm just going to say $1,800 to $2,000. Can the seller pay for that? Yeah, they can, if you've negotiated that in your contract.
Is a lot of that closing costs, is that something that the home buyer has to come up with that money too?
Yes.
Like a separate check? Okay.
Usually. And we do have programs that, those first-time home buyer programs that we talked about, that will give you only have to come up with $1,000, and then they have some assistance money that can pay for your closing costs. But for the most part, yes, you're coming up with either your down payment if it's required, and then your closing costs.
Okay, there's another term, earnest money. What is that?
The earnest money is kind of, that's actually goes into the realtor or to your, if you're buying a house for sale by owner, then that's good faith money that you're going to buy this house.
Okay.
And that's usually entered into the contract. It could be anywhere from $500 to $1,000. It is deposited right away. I like to tell my people that.
Make sure you have that money.
Yeah, it's in there. They're going to cash that. But that's just saying, yes, I'm going to buy this house unless something comes up unforeseen that can't allow that to happen.
So you've got to think ahead that you're going to have some cash of your own for not just only the down payment, but maybe that earnest money and also closing costs.
Right.
So you got to have a little bit set aside.
Yeah, that's right. And and insurance too. Homeowners insurance is paid a year in advance, and that's something that would happen before we get to closing.
So do you have to come up with that, or can that be rolled into your mortgage, or
only if it's a government program.
Okay.
If you're doing conventional lending, then you're going to pay for your first year of homeowners insurance out of your pocket up front before we get to closing.
All right. So don't start the home looking process until maybe you have some of that money stored away.
Right. That's right.
I wanted to ask real quick. I know you had said before we started taping, in this area, we don't deal a lot with points, but that might be a term they're looking online, they see points. What are points?
Yeah, a point is, it's actually 1% or 2%, whatever points there are, percentage of your loan amount. And that is, you're actually prepaying, you're paying your interest rate down. So you're actually prepaying this to get your interest rate lower for the life of the loan. And so we're going to calculate to make sure if you're going to pay this amount of money to lower your interest rate, we're going to see what the difference of those two rates are to see if it really is going to be worth your cost. Typically, a point could cost you, it may take 5 years or so just to recoup those costs. So how long are you going to be in the property? Do you have the funds to come up with to pay down your rate?
But that's not really a common practice around here?
It's not.
Okay.
It's not at all. I think it is throughout the nation, but it's just not with us.
All right. Well, we all know, watching the news, in 2007 we had the real estate bubble burst, and that actually brought about some changes in your industry. And you had talked about appraisers and appraisals as one of the changes. Can you expand a little bit on that?
Yeah, it's just that, I think they were just looking at what happened that made values not be where they need it to be. So the appraising part of it is, they have higher restrictions now, I know also, and the lenders do too. I don't talk with the appraiser. It goes through a separate department. I'm really kept out of that process so that I'm not influencing any part of the value of the property. I think it's a great idea. In our area and with me, I know it wouldn't have happened anyway, but I think it did happen throughout the nation.
So the point is that the house cannot be worth, the loan can't be worth more than what the house is worth, correct?
Right, the purchase price. We're looking, if someone's buying a purchase price, we want it to appraise out at that value or higher, but at that value. And if it doesn't, then the buyer would have to pay more money into the loan, and they'd have to buy a house that's worth more than or it's not worth as much as they're paying for.
Does that happen very often, where the house appraises less than what the mortgage is worth?
Yeah, we don't see it a lot.
Okay,
we just don't. I think it's really we deal a lot with realtors in our area, and they're very good about setting the value with comparable sales. That's where values come from, comparable sales, and so they know what those are, and it doesn't help anybody to have a property overpriced.
Right.
You know, that's not going to appraise out. The loan's probably not going to happen. So they're really good about setting values.
So as we've got about 5 minutes left, if you're thinking about buying a house, how long should you stay in that house before for it to be beneficial to you in the long run?
Yeah, that's a good question, and you know, because when you're putting $1,000 into the house and you don't start out with any equity, you know, even to stay in there 5 to 7 years, you may not make money off of your house, or not much, but. So I think the rule of thumb is just, you know, what are you looking for? Are you looking for a house that that you're able to grow into with your family, or you need to set a purchase price right now that you can live in the property for 5 to 7 years, and then let that be your next stepping stone.
So does it take, you know, 5, 7, maybe 10 years before? You know, when I look at I just bought a house about 2 years ago, and I look at the principal, and it's still most of it's still going to interest. At what point when you own your house do you really start truly paying off that house?
Well, and that can depend on your term too. 30 years. If you didn't pay much down in your down payment, and you're a 30-year mortgage, you know, you may not see a big difference for 5 or 7 years or longer. If you're paying on a 15-year term, you know, you're going to see that a lot quicker. You're going to really see that principal start
to go down. Okay. Let's just talk a little bit about interest rates. For a while, they just kept going down, 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 down. Where are they at generally? Are they kind of staying at about the same place?
Yeah, they really have. I've been surprised. I mean, we may have seen them a little bit higher, we may have seen them a little bit lower, but they're really holding steady, and we're just now getting into the season. You know, this is now going to be hopefully our buying season.
Right.
I mean, we've seen some purchases out there, but I'm hoping that with better weather and the rates being low, we can start seeing more growth.
So it's not quite that frenzy that it was, like, oh my God, if you want to buy a house, buy it now because the rates are going to go up.
Right.
They seem to kind of, where about is the average interest rate now for, say, a 30-year
30 years, about 3.75, something like that for a 30-year fixed rate loan. And you know, the interesting thing about rates is that we just don't know. We don't know where they're going to go, but they're good right now.
So when this is the question I have, because I've been in this position, at a certain point, you've got to lock in your rate. And usually when do you do that? You find the house, and then that's when you take over.
Right. Well, you know, I give them the option. You can lock it in or you can float. It just depends on how, you know, how nervous you're going to be. And, you know, I really, especially when the market was just, the rates were going a quarter of a point here, a quarter of a point there. You know, I said, you just have to find a rate that you feel good about and just go with it and just don't look back. And if you don't want me to, I won't tell you what it will do or how that changed. But
it's going down by fractions, not generally 2 to 3 to 4 whole points at this stage. So Mary, in this last minute, home buying is very exciting. It's a new step for people, but it can also be a little bit stressful. So what last little bit of advice do you have for people who are starting the home buying process for the first time to make it as enjoyable as possible?
Right. Well, I think it'd be good to to kind of know where your budget is, know what kind of payment you'd like to make, and then get all your papers together. You know where your taxes are and your W-2s and your pay stubs. And then seek out a lender and try to figure out where you really want to be, what kind of priced home you feel good about, what you feel comfortable with.
All right, because it's an investment and something that hopefully you and your family can grow into and enjoy.
Absolutely.
Well, thank you so much for coming by Money in Your Pocket today and educating our viewers on home buying.
Thank you.
Thanks.
Okay.
Here's the bottom line for buying your first house. Mary White recommends getting your credit in order because it will have an effect on not only your interest rate, but also if you will be approved or not. Allow 6 to 12 months for your credit to heal. Next, seek a mortgage lender before house shopping. A lender will not only help you determine how much house you can afford, but will tell you about the many home buying programs that are available for first-time home buyers. When it comes to your mortgage payment, remember that it doesn't include your taxes and insurance, so think about adding a few $100s to that payment. And finally, make sure you have some cash on hand for closing costs, 1 year of interest, and earnest money. Keeping these tips in mind will help you on the road to home ownership, so good luck. Thanks for joining us this week, and we'll see you next time for Money in Your Pocket.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By Members' Choice, this institution is not federally insured.